Hello everyone, my name is Jack Luttge. Today I want to talk to you about debt to income ratio. Now, debt to income ratio is one of the criteria that lenders use to assess your ability to repay a loan, along with things like your credit score. So if you have ever applied for a loan and even though you had a great credit score and it was still declined, it was probably either due to the collateral being insufficient, like an appraisal on a home being too low, or your debt to income ratio. So it's a pretty simple calculation, but it's one that a lot of people have either never heard of or don't quite understand how to calculate it properly. So I'm going to teach you how to do that today. So to do that, I'm going to use an example of a guy named Joe. It's a guy I made up. It's not a real person. The names and dates have been changed to protect the innocent. So let's say this guy named Joe, he's a mechanic and he makes $20 an hour. So we'll start with that. $20 an hour. So we need to figure out his total monthly income, which is the first part of the debt to income ratio. So we're going to take $20 an hour times 40 hours a week, which gets us to $800 a week in pay. Now, from here, we need to get to his annual income. So we're going to times that by the number of weeks that are in a year, which is 52. So we're going to take this number times 52, and that gets us 41,600. That is Joe's annual income, assuming that he works 40 hours every week and makes $20 an hour. Some people already know their annual income, and if so, you can skip all these first steps, but if not, this is how you get to your annual income. From here, in order to convert to monthly income, we just simply divide that by 12. So we divide that by 12, and that gets us our monthly income, which is $3,466. There we go. So this is Joe's monthly income. That's the first half of this calculation. Second half is his debts. So Joe's debts, quick thing on monthly debts, this gets confusing to a lot of people. There's only certain things that qualify as this, and they are literal debts. So like your phone bill, utilities, those are not included in this. It is strictly anything you have a loan or a line of credit for. So like credit cards, student loans, car loans, boat loans, motorcycle, anything like that gets counted in this number, as well as your housing expense being either your monthly rent or your monthly mortgage payment. So in Joe's case, his rent is $700 a month. He has a small little one-bedroom apartment in St. Charles County. Very nice, $700 a month. And then he also has credit cards. He has credit cards with a minimum monthly payment. We go off of the minimum monthly payment of $200 a month. He's got a little bit of credit card debt, and that's his minimum monthly payment. Now that's important too. A lot of people pay extra on their credit cards, and that's great. Please do that. If anything, pay them off every month. That's always recommended. But for this calculation, we go off of the minimum monthly payment. And then the last thing, he's got a car, and he's a mechanic, he's a car guy, and he has a thing for expensive sports cars, and his car payment is $400 a month. So there we go. That is his monthly debt. So we're going to add all that up together. That's 7 and 6. That's $1,300 a month in debt. So now, that is a horrible looking 3. Anyway, so to get your debt to income ratio, first we figure out what his income is, monthly income, $3,466, and then monthly debt, $1,300. And we're going to take those numbers and divide them. We're going to take his monthly debt, $1,300, divided by monthly income, $34.66, and we get 38. This guy has 38% debt to income ratio. Now, there's a lot of there's every institution has different criteria of what's a good debt to income ratio, what's a bad one. They typically have limits. You can't go above X debt to income ratio. For someone who wants to buy a home, most first-time home buyer programs require a debt to income ratio of under 45%. So he's within that. And one thing you want to consider if you're thinking about buying a house is your monthly mortgage payment. It has to fit in this ratio. So if you, in Joe's situation, he wants to buy a house. So we're going to figure out how high his mortgage payment can be in order for him to qualify at 45%. So in order to do that, we take his monthly income and times it by 0.45. This is the easiest way to do this. So 34.66 divided by, times 0.45. And that gets us, you can't see that far down. That gets us 1,559 and some change. 1,559. That is the total monthly debt that Joe can carry on his monthly income at 45%. So we take out of that his credit cards and his car, because when he buys a house, he's not going to be renting anymore. So we can leave that one out. So we just take the 2 and the 4. So we minus $600 from that number. So his maximum mortgage payment is not 1,000. It is 900 and what would that be? 41. $941 a month. 1,559 minus 941. Head math was never my strong suit. 1,559 minus 600. 959. See? Way off. Lesson learned. Use a calculator. 959. So that is his maximum mortgage payment that Joe could qualify for based on his income. So that concludes our lesson today. I hope that is helpful for you. If you have any questions about this, feel free to message me or text me or call me anytime. I am here to help. Thank you very much. Have a great day.